In the previous clip, we used the financial reporting system to illustrate inherent risks. We used examples of new calculations or new transactions that the company enters into that may increase the risk of misstatements. Complex calculations, for example, it's a difficult calculation, it's the first time that the company is doing it, it is more likely to be misstated on the financial statements. Let's take a look at the next component. Management is aware of the fact that inherent risks exist. They may not call them inherent risks, but they are definitely aware that errors creep into the system. Management is responsible to develop controls that prevent these errors from happening in the first place, or at the very least, detect and correct them. Controls, therefore, are said to prevent, detect, and correct error. Please note that these two belong together. It is useless for a client's system to detect error and watch it flow through the system. It needs to detect it and correct it as one. What this means for the client's information is that an error that takes place, for example, our 12 Rand that was miscalculated, would hit the control. I generally refer to it as a wall of controls, saying that an incorrect information or an incorrect amount will hit the wall and will not be allowed further unless the information is correct. This particular wall of controls will detect that there is an error and it will correct it coming out the other side of the system so that the rest of the information is fairly presented and no longer creates a misstatement. The controls are management's responsibility and not the auditor. It is vital to remember that the auditor is only interested in controls as far as they can use them to evidence the fair presentation of the financials. Logically, if the wall of controls are effective, if this wall is effective, there cannot be misstatements on the other side of the wall because any errors that would hit the wall would be corrected and they would come out as accurate information on the other side. What if management's controls are not effective? I generally talk about this as having holes in the walls of our controls. This means that although the controls do exist, they are not consistently applied or they are not effective for the purposes. When this error takes place, the misstated information will be able to travel straight through the wall because of the weaknesses in those controls, and therefore, even though there is a control, the information on the other side of that wall will still be misstated, and you will still have a misstated set of financial statements. It's important then to realize that just because a client has controls doesn't mean that everything will be accurate at the end of the day. The risk is called the control risk, the risk that the client's controls do not prevent, detect, and correct error. It is vital to remember that control risks do not cause misstatements. Misstatements are caused by the inherent risks. The inherent risks cause the misstatement. Control risks will merely allow the misstatement to travel through the system and land up on the financial statements. Therefore, our audit risk is a combination of both the inherent risk and the control risk. We'll discuss audit risk just now.